Fred writes in, Al. So I guess we touched a chord a couple weeks ago. Maybe it was last week. We talked about Edelman's view on Roth IRAs, and we gave our opinion on.
Yeah, I guess one of our listeners had a different take.
He goes, "Yeah, I listened to your podcast that deals with the critique of the Roth IRA, and I have to agree with Rick Edelman on this one. The one issue that was not addressed in the podcast was the difference between the tax bracket when depositing and the tax bracket when withdrawing the money. Most Americans will not be able to retire with the same income they enjoyed while working. They will be in a much lower tax bracket when they withdraw the money than when they deposited the money. If this was not the case, then I stand corrected. But I doubt most households making $100,000 a year have $2 million, 4% rule, plus Social Security in their retirement funds. I'd be very interested in hearing your thoughts on this subject." All right. Fred, I agree and disagree with you. You're right. I would say that when you hear about the average person, the median balance of a retirement plan is abysmal. There's not a lot of money. Half of the population does not file a tax return.
Right.
So when I say the majority of individuals will retire in a lower tax bracket in retirement than they are right now, I would agree with you with 100% certainty. Unfortunately, when you're looking at tax planning and tax planning strategies, those strategies apply to individuals that pay taxes. So if I don't have a retirement account and I'm going to live off of maybe pension and Social Security, then there's no need to even think about or hear or listen to a podcast about Roth IRAs or Roth conversions. And also, a lot of people will be in a lower tax bracket without question. But I think a lot of people that listen to this program also want to maintain their same lifestyle, that have done a pretty good job of savings, that have Social Security, that have real estate income, that have pension income, and that have saved several $1 million in retirement accounts. Those individuals, I think, would absolutely benefit from a conversion. Also, we look at brackets in regards to if I'm going to be in X bracket today and maintain that same bracket. So let's say I'm in the 15% tax bracket today, taxable income of roughly $80,000, and I want to be in the same bracket in retirement. Does a conversion make sense? We believe it does. It gives you a lot more diversity when you're pulling assets out. And also the 12% tax bracket today is due to go up to 15%. If I'm in the 25% tax bracket today or the 22% tax bracket, is there a likelihood chance of me getting into the 25% tax bracket in retirement because the 22 is going back to 25? Al and I have been doing this a couple of weeks, and we see that, yes, that happens often. So it really depends, of course, on the circumstance. But I agree with your statement. Is like, yeah, with a lot of people making $100,000 a year, do we see these people having a couple $1 million in retirement accounts? Not necessarily, no.
Yeah, I agree with you wholeheartedly, Joe. And I think that and maybe we didn't really express this well enough in that critique, is you always have to look at your tax bracket today.
Yeah, I mean, we just took that as a given.
Yeah, we did. Yeah, you look at it today versus the future. Now, if you're in the 37% tax bracket today and in retirement you've saved nothing, you're going to be in the 12% or 15% as it's going to become. Absolutely not. Roth conversions would make 0 sense, right? But if you, in a lot of cases, what we find is folks save the majority of their savings in retirement accounts, and they want to live the same lifestyle. And a lot of the people that we talk to have the savings to be able to do that, whether it's savings, pension, Social Security, real estate, whatever it may be. And so when you look at that, then it's like, well, wait a minute. If they want to live the same lifestyle and they got to basically pull every dollar out of their retirement plan, then that they are by definition going to be in the same tax bracket. In some cases, higher tax brackets because their required minimum distribution is more than they need, so that's part of it, or because their home mortgage is paid off, so they don't even itemize their deductions anymore. All that has to be looked at on a very individualized basis. It's very hard to say it generally. Everyone should do this because everyone's situation is different. But if someone who's listening, if they know they're going to be in a lower tax bracket in retirement than they are right now, a Roth conversion may not make sense.
But then I would say most people that are looking at a retirement income strategy, and it's like, okay, I'm 5-10 years out from retirement, then you have to look at it fairly closely. But let's say if I'm a younger listener, if I'm 20, 30, 40 years old, then you've got the time component of how that tax-free compound growth will then some point outpace the traditional IRA. But that's a totally different argument. That's a totally different thing that we usually never touch on. What we look at is to say, if I need to replicate the same paycheck that I'm getting today, or something similar, maybe it's a little bit less, but what we find, again, doing this for as long as we have, is that a lot of our clients, a lot of people that seek really good financial planning advice, spend more money. They're going on trips, they're going on vacations, they're redoing their house, they're buying an RV, they're spoiling their grandkids, because it's Saturday every day once you're retired and you find time to spend money. So most people want to, in our scenarios, in this assumption, they want to replicate their paycheck. And if everything is in their 401k plan and everything is coming out taxed just like their paycheck minus FICA tax, the likelihood of them being in a significantly lower tax bracket, we find they don't.
Something else that most people don't know, most accountants, I would say, don't even know this, and that is when you're in the lowest tax bracket, or the lowest two tax brackets, which is now 10% and 12%, and it used to be 10 and 15%. So I'm going to use the 15% amount. So a lot of folks that were in that bracket receiving Social Security, their income was high enough that it would force more of their Social Security income to be taxable. And if you can follow this, you add an extra $1 of income, it makes another 85 cents of Social Security taxable. And what we were seeing before this new tax law is that folks that thought they were in the 15% bracket were actually in the 27% bracket. When you look at what we call marginal, or a few more dollars out of my IRA is going to cause a higher tax, there, in that situation in particular, getting money into the Roth IRA would be very beneficial.
Right, because what you have to look at that component, or in that circumstance, is their provisional income. How is their Social Security going to be taxed? What does that look like? So it's half of the Social Security plus their adjusted gross. But they don't include Roth IRA distributions from provisional income. So if there's a way that you can then push out, let's say, your Social Security income, do Roth IRA conversions to a certain bracket, and then get a lot of the retirement accounts into a Roth, and then you can reduce the RMD to keep you from a 0% tax bracket from a provisional standpoint, or maybe only 50% of your Social Security benefits are subject to tax.
Right. And
then you can take additional distributions from a Roth IRA and have a lot higher cash flow, right? Without getting yourself into a higher tax bracket. I think that makes sense.
Yeah, and one other thing, I hate to say it, but in terms of married couples, one
dies.
One will survive the other. And the survivor now is a single taxpayer. The tax brackets are cut in half. So now it's like you've got virtually or almost the same income, right? But you're hitting those next brackets much sooner.
How about this? They're looking at changing the stretch IRA provision, that only $450,000 then can be stretched. What that means is stretch out the tax liability over the beneficiary's life expectancy. If you have a large IRA and you got to split that thing out within 5 years, that could blow your kids' tax brackets up. So if you can do it strategically and convert into lower tax brackets over a next 5, 10, 50, 20 years, does that make sense? So there's multiple ways of looking at this. So when you look at hearing Roth conversion, and then it's like, well, if I'm going to be in a lower tax bracket in retirement, because that's what everyone says. That's the biggest fallacy to most people that have saved money. Because a lot of things that we see, yes, they're in the same bracket or higher. But as a country as a whole, yes, they will be in a lower tax bracket. So I agree with you there. But I think you're missing the point of strategic planning. And we don't know anyone that's listening out there. I don't got a balance sheet in front of me. We're just throwing out ideas to see if it catches, someone's interest. And then what they do is they blow it up, and then they email us later and saying, hey, I think I did this wrong.